In the world of investing, few names resonate as strongly as Peter Lynch. As a legendary fund manager at Fidelity Investments, Lynch achieved unparalleled success, consistently outperforming the market. His investment philosophy, centered on understanding companies and their potential, continues to inspire both novice and seasoned investors. Lynch's approach wasn't about chasing abstract market trends. It was about knowing the businesses behind the stocks. This video delves into the heart of Lynch's investment strategy, exploring the different categories of companies he identified as key to successful investing. Investing without understanding the nature of a company is like setting sail without a compass. Peter Lynch emphasized that categorizing companies is not merely an academic exercise, it's the bedrock of a sound investment strategy. By understanding the different categories, investors can better assess risk, anticipate potential returns, and make informed decisions aligned with their financial goals. Consider this. A fast-growing tech startup carries a different risk profile than a well-established utility company. Each category comes with its own set of opportunities and challenges. By understanding these nuances, investors can diversify their portfolios strategically, mitigating risk while maximizing returns. In the realm of investing, the allure of rapid growth often steals the spotlight. Yet, Peter Lynch recognized the importance of a less glamorous but equally vital category: slow growers. These are companies that have already reached a significant size and hold a firm position in their respective industries. Slow growers are not in the business of reinventing the wheel or chasing the latest fads. Their strength lies in their stability and predictability. While their growth might not set the market on fire, their stability and resilience make them a valuable addition to a diversified portfolio. Identifying slow growers requires a keen eye for companies that prioritize stability and consistent performance over rapid expansion. Slow growers often operate in mature industries with limited potential for disruptive innovation or rapid growth. Look for companies with a track record of steady revenue growth, stable profit margins, and consistent dividend payouts. Slow growers typically maintain conservative debt levels, preferring to fund their operations through internally generated cash flow. Remember, identifying slow growers is about recognizing the value of stability, consistency, and predictable performance in a well-diversified investment portfolio. Like any investment, slow growers come with their own set of advantages and disadvantages. Stability and predictability, consistent dividends, lower volatility, attractive valuations, limited growth potential, susceptibility to interest rate hikes, risk of disruption. Understanding these trade-offs is crucial for making informed investment decisions aligned with your financial goals and risk tolerance. This makes them attractive to income-oriented investors seeking a reliable stream of passive income. In the world of investing, as crafted by Peter Lynch, stalwarts hold a unique position. They aren't the flashy sports cars of the market, but rather the reliable SUVs, built for consistent performance and a comfortable ride. Think of them as the giants in their respective industries, often holding leading market shares and boasting a history of steady growth and profitability. Consider a company like Coca-Cola. It's been a household name for over a century, with a globally recognized brand and an extensive distribution network. This constant reinvention within a framework of established market presence is a hallmark of a stalwart. Recognizing stalwarts in the vast landscape of the stock market requires a keen eye for companies that have successfully navigated the challenges of growth and emerged as dominant players in their respective industries. Stalwarts typically have large market capitalizations, placing them among the largest publicly traded companies. These companies have spent years, even decades, building their brands. Look for a history of consistent revenue growth, stable or expanding profit margins, and a healthy return on equity. Remember, identifying stalwarts is about looking beyond the allure of rapid growth and recognizing the value of stability, consistent performance, and strong market positions. As with any investment strategy, investing in stalwarts comes with its own set of advantages and disadvantages. Reduced volatility, consistent returns, downside protection, growth potential, limited upside potential, valuation risk, susceptibility to disruption. Understanding these trade-offs is crucial for making informed decisions about whether stalwarts align with your investment goals and risk tolerance. This makes them attractive to income-oriented investors seeking a reliable stream of passive income. Fasten your seatbelts, because in the world of investing, as envisioned by Peter Lynch, fast growers are the rocket ships poised for a thrilling ride. These are the companies that ignite the imagination, the ones with the potential to rewrite the rules of their industries and deliver exponential growth. They are often found in emerging sectors, driven by innovation, disruptive technologies, or a rapidly expanding market. Imagine investing in Amazon during its early days as an online bookstore, or Apple when the first iPhone was launched. The key to success with fast growers lies in identifying those with a sustainable competitive advantage. Identifying fast growers requires a keen eye for companies that are not only growing rapidly, but also demonstrate the potential for sustained growth and profitability. Fast growers typically exhibit revenue growth rates that significantly outpace the overall market or their industry averages. Fast growers often operate in markets that are themselves expanding rapidly. Many fast growers are at the forefront of innovation, developing new technologies, products, or services that disrupt existing markets or create entirely new ones. Remember, investing in fast growers is not without its risks. Investing in fast growers is like riding a roller coaster, exhilarating but not for the faint of heart. Fast growers offer the potential for extraordinary returns, but they often experience significant stock price volatility. Execution missteps or competitive pressures can derail even the most promising companies. Investors need to be comfortable with a longer-term perspective. In the market's dance, as Peter Lynch observed, not all companies move to the same rhythm. Cyclicals are deeply intertwined with the economy's ebb and flow. They grow during booms and contract during downturns. Understanding this is crucial for investors. Imagine the economy as a giant wheel, turning through expansion and contraction. Cyclicals ride this wheel, flourishing in upswings and feeling the pinch in recessions. Identifying cyclical industries requires a keen understanding of how different sectors respond to economic fluctuations. Here are some key characteristics to look for. The most defining characteristic of cyclical industries is their direct correlation with economic expansion and contraction. Their revenues, profits, and stock prices tend to rise and fall in tandem with the overall economy. Many cyclical industries cater to discretionary spending, meaning consumers and businesses can delay or forego purchases of their products or services when times are tough. Examples include automobiles, luxury goods, travel, and entertainment. Cyclical companies often have high fixed costs associated with maintaining their operations, such as manufacturing facilities, equipment, or a large workforce. These fixed costs can amplify the impact of economic downturns, as companies have less flexibility to adjust their expenses when revenues decline. Some cyclical industries, such as materials, energy, and industrials, are heavily reliant on raw materials whose prices can fluctuate significantly based on supply and demand dynamics. These price swings can impact profitability, making these sectors particularly vulnerable to economic cycles. Investors can track various economic indicators, such as GDP growth, consumer confidence, unemployment rates, and manufacturing activity, to gauge the health of the economy and anticipate potential impacts on cyclical industries. Recognizing these characteristics can help investors identify cyclical sectors and make more informed investment decisions based on their assessment of the economic outlook. Investing in cyclicals is akin to riding the waves of the economy. It can be exhilarating and potentially lucrative, but also requires careful timing and a strong stomach for volatility. During economic expansions, cyclical companies can experience significant growth in revenues and profits. Economic downturns often create attractive value investing opportunities in cyclical sectors. One of the biggest challenges with investing in cyclicals is accurately timing the economic cycle. Unexpected events can quickly alter the economic outlook and impact cyclical industries. Some companies resemble prize fighters down on their luck, but with the potential for a triumphant comeback. These are the turnarounds. companies that have faced significant challenges. Their stock prices have likely taken a beating. However, for the discerning investor, turnarounds can offer rewarding opportunities. Imagine a once mighty athlete sidelined by an injury, working back to peak performance. Similarly, turnaround companies are often restructuring to regain their competitive edge. Investing in turnarounds is not for the risk-averse. It requires understanding, belief, and patience. But the rewards can be substantial. Identifying potential turnarounds requires a discerning eye for signs of life and understanding the factors that drive success. A change in leadership, especially a CEO with a proven track record, can indicate a potential turnaround. New management often brings fresh perspectives and urgency. Look for companies actively addressing their problems, like selling non-core assets or investing in new technologies. Turnaround candidates often focus on reducing debt levels. Improving profitability is a key sign of a successful turnaround. Investing in turnarounds is like panning for gold. It requires patience and diligence. Successful turnarounds can generate substantial returns. As the company's prospects improve, its stock price can appreciate significantly. Turnaround companies are often overlooked by the market. Investing in turnarounds is inherently contrarian. Identifying potential for a comeback offers profit opportunities. Turnarounds are driven by catalysts like new products or restructuring. These events can drive stock prices higher. Not all turnarounds are successful. Many companies fail, resulting in further losses. Investors need patience for long-term recovery. Turnaround stocks are often highly volatile. Companies may need to raise additional capital, diluting ownership. Deep understanding of the company and industry is crucial. Deep understanding. Some companies resemble treasure chests waiting to be unlocked. These are the asset plays, companies with valuable assets not reflected in their stock price. Hidden gems might be overlooked due to underperformance or complex structures. For astute investors, asset plays offer a chance to acquire valuable assets at a discount. Imagine finding an antique clock at a flea market, its true worth hidden beneath dust. With a little polishing, it could be worth far more. Similarly, investors can unlock significant value in asset plays. These assets can be real estate, natural resources, or intellectual property. The key is finding companies where asset value exceeds market capitalization. Identifying asset plays requires a keen eye for undervalued assets and the ability to see beyond a company's current financial performance. Here are some key characteristics to look for. Look for companies with assets that are not fully reflected on their balance sheet or are being carried at historical cost, which may be significantly lower than their current market value. This could include real estate, natural resources, patents, trademarks, or valuable brands. Break down the company into its individual components and assess the market value of each asset or business unit separately. If the sum of these parts is significantly higher than the company's current market capitalization, it could be an asset play. Companies may choose to spin off or divest non-core assets or business units to unlock value for shareholders. These transactions can create opportunities for investors to acquire a stake in undervalued assets that were previously hidden within a larger corporate structure. Keep an eye on companies that are being targeted by activist investors. These investors often see hidden value in underperforming companies and may push for changes, such as asset sales, spin-offs, or management changes, to unlock that value. Look for companies with low price-to-book ratios, low price-to-sales ratios, or high dividend yields, which could indicate that the market is undervaluing their assets. Remember, identifying asset plays requires thorough research and a willingness to dig beneath the surface to uncover hidden value. Investing in asset plays can be like unearthing buried treasure, potentially lucrative, but not without risks. The allure lies in acquiring valuable assets at a discount. If recognized, the stock price can appreciate significantly. Undervalued assets provide a margin of safety. Catalysts like asset sales can unlock hidden value. Asset plays often require a long-term horizon. Poor management can erode shareholder value. As we conclude our exploration of Peter Lynch's investment philosophy, one overarching theme emerges: knowledge is power. By understanding the nuances of different company categories, from the steady reliability of slow growers to the hidden potential of asset plays, investors empower themselves to make more informed decisions. Lynch's approach wasn't about chasing hot tips or trying to time the market. It was about rolling up your sleeves, doing the research, and understanding the businesses behind the stocks. Remember, each category comes with its own set of opportunities and risks. Slow growers offer stability and consistent dividends, but might lack the sizzle of rapid growth. Stalwarts provide a balance of growth and stability, but can be susceptible to disruption. Fast growers hold the potential for explosive returns, but come with heightened volatility. Cyclicals ride the waves of the economy, offering lucrative opportunities for those who can time the cycle. Turnarounds present a chance to capitalize on a company's comeback story, but not without significant risks. And asset plays, like hidden treasures, offer the allure of unlocking hidden value. The key is to align your investment strategy with your risk tolerance, financial goals, and time horizon. Are you seeking steady income from dividends? Slow growers or stalwarts might be a good fit. Looking for high growth potential? Fast growers or carefully selected turnarounds could be worth considering. Do you have the patience and risk appetite for a contrarian bet? Asset plays might pique your interest. Invest in what you know. Leverage your knowledge and experiences. Thorough research is paramount. Investing is a marathon, not a sprint. Don't put all your eggs in one basket. Be patient and stay disciplined. Investing is a journey of continuous learning.